We're here with Mike Mayer, CEO and co-founder of Howzer, which is a discount brokerage he founded in Philadelphia in 2015, and has slowly been growing over the years. Took on some investors, has continued to raise money, expanded to DC, and this year raised a big raise, like 180 million, I think, in debt and equity, and then is acquired Trelora, which is another discount brokerage. So excited to talk to you, Mike. In looking into your story in analyzing, because we covered you in the 2018 Swan Up All Twins report, which is 5 or 6 years ago, and I was looking at the report. We profiled 9 companies, only 3 are still around, and you acquired one of those 9. Redfin is the other, and then Homey, which is in Utah, which has some public struggles. They replaced the CEO, I think, this year or late last year, middle of last year. So I think it's an interesting time to talk to you because it feels like you are slowly growing and expanding the acquisition, the funding. Um, what have you what have you found that's working for your model, and like the discount the arena you're playing in? Like how are you finding it to work?
Well, first, thanks for having me, Paul. It's always good to catch up in a long time. And I think to your first point, yeah, Hauser's still here. A lot of our antecedents are no longer. I remember that Swanee Poll uh, trends report, the T360 report. I don't know if we were at the time we were called modern discount brokerages. There's always been
Hmm.
various names for this category, next gen, modern discount. But I think what's interesting about that is everyone that I've ever met, peer, industry, investor, they always talk about everyone's tried this before. What's different? Why
Yes.
succeed? And I think that's like an interesting dimension to talk about just real briefly. Yeah, it's true, right? So like outside of Redfin, who launched in '04, went public in 17, still out there. One key differentiator about Redfin from almost every other next gen brokerage that's followed suit is Redfin had a search engine. They built a pretty dominating portal that's grown year over year, and it's allowed them, I think, to do a lot of different things by way of proprietary lead gen that's allowed scale become achievable for them. When you look at all of our antecedents dating back to Foxtons, never got out of that,
Yep.
you know, market. And then you look at, Purple Bricks,
That
decided
was
to
a big
launch.
one. They came in big
Yeah,
in the US from the UK and just like
right.
crashed and burned. And
Started
it's
in,
like, so I think before, like, I want to ask like what's
yeah,
some of the difference and what's working, but like I think it's good to like describe actually what the model is. Like you
yeah,
guys offer a flat listing fee to sellers for 5,000 $5,000 flat fee, and you give relatively full service. You have employee agents, and I know you've expanded to ancillary, which I want to talk to is later. But like that's the basic model, and you also, of course, offer buyer services, and that's just like for the commission that paid on the listing side. So, why do you think you guys have like what are you doing that you're finding success and staying power with your model? Because it's similar to some of these others, or just like little flavors of the same for the most part.
yeah. As I was articulating kind of the laundry list of, Purple Bricks and Really and Redefy and Door, and then you outlined Howzer, Homie, Trey Laura. I think one of the insights we gleaned fairly early is we were probably one of the least um, capitally resourced. And so
Yep.
when you're one of the smallest and resources are scarce, I think you tend to focus a little bit on execution more. I remember talking to several investors and, given my background as a former naval officer, I think the drum we've always kind of have beaten is the maniacal execution required to scale this business is really intense. It's an operationally
Yep.
intensive business, scaling real estate brokerage, mortgage and title, market by market, um, and building
So
brands hard.
I
So
think it's now
execute.
like it'd be good for context. Like what is your volume in 2022, and what were your units?
I think in 2022, just Hauser alone, besides Trey Laura, we were probably pushing, somewhere between 1,000 and 2,000 units, and whatever derivative sales volume comes from that. One reason we don't talk in sales volume, Paul, generally is because we don't always benefit from the sales volume with a flat fee listing model. So it's not an easy cut like a traditional brokerage could say sales volume times 2.5 and get to revenue. We're 5,000 flat on the listing fee. So I don't always look at volume. It's less of an indicator, but sides, I would say a couple thousand sides, and looking to add more with the Trailura acquisition. Um, we're generally small when you look at sides, but you gotta in the industry compare traditional brokerages and how they scale by scaling agent headcount, and sides are derivative of that. And so as agent headcount changes, so does that. But you know, one of the things I always struggle with is when you talk size and volume to the traditional brokerage model, comparing them to us is apples and oranges because they're running a company dollar of eight to
Yeah,
12.
volume has a different. It's like
It's a different
it relates
meaning.
to their bottom line in a completely different way. Yeah, it does.
Exactly.
It does allow us to at least contextualize like what kind of volume are you handling on the market, and where does that fit you into the overall scheme. So we can talk offline because I would love to contextualize that as we just a little charts like because it really helps people understand like what's the scope here because to your point you're talking about scale is the lock to is the unlock a lot of opportunity in this model and a lot of others, and that's the hard part of like achieving scale. So anyhow, um, so you're talking about what are you finding working? Because it seems like you've been slow and methodical and like launching and growing your markets, and with the Trolora, you've kind of expanded quite a bit into a few more markets. How many markets are you in now with the Trolora acquisition?
We went from 7 states and 10 markets to 14 states and about 25 markets and continuing to grow that footprint. We're doing that in a bunch of different ways. But I think you're right. I think slow and methodical day-to-day execution has been the rallying call for us, and it's going to continue to be that way. We learned a lot of insights along the way, but the Trailura acquisition, I think, has opened up our eyes to allowing us to get to a place of material transaction volume, scale, and eventually market share. That's going to take a little bit of time, but M&A is an interesting way to accomplish the scale goal and get more transactions across this fixed cost space. That's what I don't think anybody has an appreciation for. If you're going to be a one-stop shop in one market, you're making those fixed cost investments in product, technology, mortgage, title, brokerage. And that's a heavy lift. But the best way to amortize that fixed cost expense is through scale. And by scale, I mean transactions. And we're able to get that with the Trailora acquisition.
I just basic block and tackle. Are you going to keep the Trailora brand and or are you merging that with Howzer and gonna merge those into a new brand or your brand?
Right now, in the short term, we're going to continue to have Trailora in all Trailora markets and Howzer in all Howzer markets. We're we're flirting with this idea of doing a couple things we'll announce probably in the next 30, 60 days, but likely introduce a parent brand similar to what
Mm-hmm.
CoStar has done.
Mm.
And we'll likely probably continue to be aggressive and look to roll up a couple more assets. Those assets could be technology, they could be other brokerage brands, but we definitely have learned that there's some value in the brands that have been built, particularly in these respective markets. And there's an opportunity to also continue to segment the product offerings based off of the various customer segments that exist in this category.
Yeah, yeah, and we'll get to that in a second. So you mentioned the benefit of scale. Like, what are the key levers that you're looking at that unlock when you have scale? Because a lot of these other companies have come in and looking for scale, and Purplebricks and like obviously Redfin is a one we've already talked about, and they're bigger and they've achieved a certain level of scale. But what becomes much easier for you guys at scale specifically?
Yeah, so when I say scale, what I really mean is getting incremental transactions to drive operating leverage. So when you do an M&A deal, obviously there's one management team that's coming over, there's one product team, there's merging of the mortgage and title team. So those cost side synergies allow you to take that transaction volume that's accretive and not take
Yeah,
on the additional cost burden. So
yeah,
like the
yeah, yeah,
operating leverage in this business, we'll see our gross margins increase probably from like target 50% gross profit margins to probably like target 65% gross profit margins. And a big part of that is just bolting on the cost and revenue side synergies that come with an acquisition like this. Obviously, zero geographic overlap with Trailura, They had Midwest and West Coast, but they also didn't really have a mortgage company. And so all of a sudden, we're taking all those incremental sides and attaching mortgage and attaching title and potentially, other services like power buying, et cetera. So that's really the key lever there is the operating leverage that you get from incremental transaction volumes across your fixed cost base.
Yeah, yeah, completely. I get it. So, when you all, because you all took on Edison Partners, is that a private equity? Was that an acquisition? Do they have a controlling stake in you guys?
Edison is the majority shareholder of our combined enterprise. I can't go into too much details about the
Totally.
transaction itself, but
Yeah, yeah.
so Edison is a 30-year growth equity firm out of Princeton, New Jersey, several billion dollars asset under management. And I would say definitely more, you know,
I ask because it. I ask because this is a part of a trend we've been seeing and like identifying and tracking over the last few years. And it's not always clear. It's like the capital required to then compete in the modern brokerage space. And we're seeing this like at World or at Properties was acquired by a private equity firm and now is being run by a private equity. They're acquiring Christie's. You guys essentially, we call it an acquisition of the majority stake and acquired by Edison and now have the capital to make these bigger moves. It's an interesting
you
it's
know, I
an
would say
interesting
when I say majority shareholder, I mean not through the lens of an acquisition. Like they don't control the board; they're the largest shareholder of all of our shareholders. But generally, the company, is still privately held and ran by the board of its select representatives. So Edison does not have a controlling stake per se.
so they okay. Just for our definition that we use the T3s for consistency, we call it acquisition when a company takes over a 50% stake in the company, just for its like simplicity, and we describe that.
Yeah, and they do not is what I'm describing.
Oh,
They do not have more than 50% stake in the
oh,
company.
there you go. Okay, okay, that's
Yeah,
good to clear that up.
I've seen a lot of private equity companies in this particular category where they're buying a majority, a controlling
Hmm.
stake. That's not the case here. They are
Okay,
acting more like a traditional venture growth equity investor.
okay, perfect. All right, that makes it clear. Okay, so it wasn't. It's a little bit of a different thing, which is how I read it, but that's why I asked you to make it clear. Okay, um, you mentioned the power buying and the alternative finance, which I think you are definitely like a lot of companies really bringing that into their core model because there's a lot of revenue there and a lot of brokerages are figuring out like, all right, how do we add this in? Because it's a way to add a lot of profit. So when you announced that the 118 raise early last year, you announced a couple of we call alternative finance like the cash backed offers and maybe the buy and sell. Um, what's Are you still buying and selling and like offering that synchronous sell, which some of these companies have been offering? Because like I couldn't find it on your site. I think it was announced, but then maybe you changed it. I'm curious about that.
So answer specifically, we're paused right now on any power buying, like most of the power
Yep.
buyers. I would caveat that with we've always looked at the power buying products, whether it's a cashback offer for buyers or an offer for home sellers or buy before you sell, as
Yep.
really financial products that would
Yep.
eventually be commoditized. So, like any
Yep.
innovative company that wants to meet a customer where they're at on their journey needs to have a financial instrument to help them reduce friction and unlock their goals. And so, we've always saw that as a normal product that we should have, and we have it now. But
Yeah.
it has never been a large portion of our business, nor will it ever be. But we'd like to
Yeah.
have facilities available should customers need those products.
Yeah. Is that so? Is the cashback offer still live, or is that paused as well?
No, the cashback offer is still live. We're just not
Yeah,
seeing
that's what
strong
I thought.
appetite from consumers for that. When there
Yep.
was a bidding war, it made a lot of sense. I think that the shift now is can you use cash to get a better strike price
Yep.
on the house? And we're
Yep.
seeing some desire there, but and we expect that to be the one product that remains in some capacity. I do think as the market kind of levels out in 23, you will see consumers looking to buy before you sell again. Less about sequencing and more about convenience. Sequencing was really challenged with limited supply and voracious demand, but there will always be a subset of customers that just like, hey, I want to move in first and move the dogs
Well,
and
well,
then
as
get
you
back
know,
to buying.
if you bought and sold, I know I have, and it's a big deal that opportunity, and I feel like whatever the final form is, and there's a lot of financial, and you guys I think have seen it. A lot of these players have started to operate. It's something that feels like it's going to be solved or be serviced in some financial instrument. um, so I wanted to ask how many full time employees do you all have now?
Between Howzer and Trey Laura, we're
Yep.
probably, I don't know, maybe 140.
How many of those are agents, licensed
Generally,
agents?
generally, when I look at my business historically, it's been about give or take 40 to 50% of those headcounts are agents. The other 25 to 30 is centralized support staff, including mortgage and title. The other 25% might be the corporate management team. That's generally the 50, 25, 25 is generally what we look at.
Yeah, yeah. Um, so because you all for that flat fee you offer um, full service in the same in-person meetings. Is that correct with
Yeah, I
with
think
with
I think that's
sellers?
one area where we haven't deviated from launch. We've been a full service brokerage since
Yeah,
day one and continue to be. So sellers and buyers are meeting with their listing agents and buyer agents. They're in the field, they're at kitchen tables, they're doing CMAs, they're talking strategy, they're sharing cell phones, they're going to inspections, they're doing open houses. Like that's the one thing I just really dislike about discounted pricing should not imply discounted service. And like explaining that to consumers has been, I think, a challenge. But Howzer, for all intents and purposes, is a full service brokerage, and I think the attach rates support that because we don't give away any money on the buyer brokerage commission, and we're still driving like insane mortgage and title attach rates, and that's based off of a real relationship that the consumer has with the agent that's rooted in trust. So agent recommendation for mortgage and title is the number one reason people select it. That has to be rooted in trust. And to be rooted in trust, you got to be full service.
yep. And so because the agents are employees, it's like they're they have like I CFPB and all that, all the rulings, but like in the relationships being clear, but like they're including the Howzer mortgage and the Howzer title as options to all their consumers for each transaction. I mean, because what's the what have you found that work to get the high attach rates or the higher attach rates than I know a lot of companies are are
Yeah,
really focused on.
a lot of people fudge the numbers based off of their business model and different things that they have going on. So, like if you're offering a power buying product where you have to use the mortgage and title
Yep.
company, calling that attach
Yeah.
is like more intrinsic to the
Yeah.
product. Ours is
Yeah.
a
Yeah.
little different. It's derivative of a few things. It's derivative of W-2 salaried agents that follow the same process system, use the same tool and technology and the consistency that we build. The second thing is just if you're driving a full service brokerage, agent recommendation. So we still do affiliate business disclosures. Consumers still have the right to
Yep.
choose, but generally agent recommendation is material. And I think that the third thing is a unified digital technological process where everything's one-stop shop, truly in-house. We've built what I believe to be the first truly digital integrated one-stop shopping experience. So one-stop shop's been a buzzword by everybody. Everyone's talked about it, but here's the deal. If you're not driving north of 50% of your mortgage through the technology and through your attach, and more than 50% of technology through the title, through technology and the sales attach, then you can't be a one-stop shop. We drive 95% title attach in our home market of Philadelphia, 85% globally. We drive 65% title attach in Philadelphia, 55% globally. So more than half of every single transaction is going through the same digital unified experience, phase by phase, transaction management, a blueprint for a buyer and seller's journey, including ties into Qualia and ties into Compass, where buyers and sellers only see one digital experience. To my
Yep.
knowledge, we're the only company that's actually been able to execute on that roadmap.
I want to get those numbers right. 65% for mortgage attach rate in Philly, and
Six,
then
65.95 for mortgage title in Philly, 55.85 globally across all markets, mortgage title. And
Yeah.
that's roll attached. So when I say fudge the numbers, some people back out cash deals, some people back out new construction. That number
Yeah.
is raw. You adjust for cash deals, you can add 10 to 20 basis points to those numbers.
Yeah. No, I mean, that's remarkably high, and those are the dreams. In the one stop, I started chuckling a little bit when the one stop shop and the digital vision and the all integrated platform. That I can't tell you how many. There's probably 40 that I've seen in the startups and also established companies. Zillow is talking about it. Redfin's talking about it. KW is talking about it. I think everybody, and it's that's one of the things we're looking to drill into in the trends report this year. Is like, just what does it mean, and what is it, and who is approaching it, who's getting close. I would love to talk with you about
If
that
you're not
as we get
driving,
closer.
if you're not
Yeah.
driving 50%, so all of your transactions obviously are going through the platform, but maybe not with 1099 agents. Who knows? With a W-2 model, more than 50% of all of our transactions go through the same digital one-stop shopping experience. Outside, if you're not driving more than 50% mortgage title attached, you actually can't say you're a one-stop shop, in my opinion.
Yeah. No, that's, I mean, that's where this model kind of, imagine that's where you're seeing the future and like how this model really works. So related, you provide full service. Your agents are meeting with the consumers in person, and but you're charging $5,000 as a flat fee for sellers. How are you able to provide that full service at a fraction of the commission or the fee that consumers are paying?
I think the reality is, whether the traditional brokerage industry would like to admit it or not, when you look at real estate commissions in the United States versus other comparative economies in Europe and elsewhere, 6% is a lot to derive value. Every economist in the world that studied this has talked about the extreme amount of waste or value that's been extracted through commissions. Tell me, why would commissions go up linearly over the last 24 months when we saw home price appreciation go up by 40%? Was the work product any different? Was the time, in fact, it was the opposite. The amount of time invested in a listing probably went down by 10x over the last 24 months, but the pricing and the commissions went up. And so for me, I've always believed, whether it's a 200K home or a $2 million home, the seller has the asset and the intent. And if the seller has the asset and intent, it doesn't necessarily cost any more from a time perspective to market and list. That home will sell in line with the days on market. It's a very, very efficient market in that submarket. Now, flip the switch on the buy side. I meet a buyer tomorrow on Zillow. They might put an offer in the next day. I work with a buyer on Zillow. I might work with that buyer for a year. The
Yep.
buyer
Yep.
journey is much more dynamic. They have the desire and the will. And so for
Hmm.
that to be a dynamic model makes a lot of sense to me. But for the listing side, even in the event that I ever went to a variable based listing compensation model, it would still be discounted because the fixed cost to market it and list a home in the age of internet search is de minimis. If you can, I'd be happy to go head to head with any top producing agent team in the country to look at our settle list ratio, our days on market, and do a
Yep.
study that says who actually yields a higher price and actually saves more, because that market is very efficient. That is a solved problem. If your
Yep.
home is priced right in the age of internet search and it shows
Yep.
well, pictures,
Yep.
photography, video, it
And
will sell.
it's in the MLS, and
That's it.
it's, yeah, yeah, it's I
I'm not
so
knocking agents, so I'm not knocking
no,
agents because
I get you. It's just
there's value.
it's
If you think you can extract 7% from a seller and get them more, kudos to you. But for the vast majority of middle class homes, it's an efficient marketplace, and the home will sell if priced right and shown right.
yeah. Um, so it's so what do you really focus on in this year to come? Like, what are you really trying to solve for? And as you've greatly grown and expanded with the acquisition.
We're looking for other opportunities. So I'm actively in market looking at assets, things like, portals, looking at other brokerage models that are either W-2 in-house models that have different geographies, or discounted models, 1% flat fees, things like that. There's a lot of opportunity for us to continue to get scale. We've been able to stand up some interesting partnerships that I can't disclose, but have been allowed us to
Mm,
also scale. And so for me, playing offense while the rest of the market is playing defense is really my goal for 2023. Trying to be ruthless with prioritization because there's a lot of opportunities bubbling up. But if
yep.
I can in 23 in about 20 markets throughout the country, increasing our transaction volume, increasing our share, that's going to be a big year for us. And I think the other thing is every company, whether they like to or not, everyone's chasing profitability. So I'd really love to be in a position where, come end of 23 and 2024, we're looking at clear line of sight to profitability, establish unit level economics, and be in a
Yep.
position where we can grow pretty substantially.
Yep. Are you profitable yet, or are you still working toward it? Is that what you were saying? That's what your target is in the next year and a half.
Yeah, I'd say the next year and a half, the goal is to get to what I would call global profitability on a unit level basis. In many of our markets, we're already profitable. We're profitable in Philadelphia. We're profitable in Denver via Trailura. Getting those other markets that we've been in for a little bit of time, whether that's
Yep.
DC or Florida or Phoenix, we want to drive all those markets to profitability. And we think we have good line of sight to do that.
Mm. All right. Well, thanks for the time, Mike. I think this wraps what I wanted to talk about. It's an interesting space, and we're watching what you do because we see you guys are one of the few that are really growing, and the discount model has been tried by many, and you're still seeing some daylight potentially, kind of scaling up and potentially being like a name like Redfin, but you still have a ways to go there. But it's something we're watching. So I appreciate you taking the time.
Yeah, my pleasure, Paul. Good to catch up. Appreciate you guys tracking us. And the thing I'll leave you with is the last 8 years of my life building this business has been in a predominantly seller's market. We went from 6 months, 5 months down to a half month of inventory. Those tides are turning. So we've withstood what I think are pretty challenging conditions. As the market shifts, it'll be interesting to track this category. I think it's really going to be the telltale. Can a business like this have the durability to extend itself beyond any market condition?
Yeah, I agree because we're entering a new new territory for a lot of companies, especially ones like have been, to your point, been founded just in the last few years. Like it's been a pretty static market. All right, we'll be talking to you in the future.